In this week's update, fear of the unknown is the name of the game. How vital is it to separate short-term noise from the sustainable trends? Gold finally showing something. And this is a commodity supercycle. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe the video. All right, let's start with some market perspective. We've got an unpredictable mess on our hands in the Ukraine. Markets hate uncertainty, and so certainly that's not going to be helping. It's not the major factor that is driving the trends in markets, as I've been saying. That was going to unfold anyway, but certainly this is making it worse. Now, if Russia stops with just the Ukraine and doesn't go beyond there in their invasions, then the global impact on markets should be quite limited, and we may have seen the worst of it. But the problem is that no one knows whether that is as far as Russia's aspirations go. And the attacks on nuclear power plants just creates a whole new ball game. I must admit, I would have thought in my lifetime I wouldn't have seen nuclear warfare in one form or another re-emerge. So that's pretty disturbing eventuality. Now the problem is that it's just the fear of what Putin might do is enough to depress markets further. He doesn't actually have to do it. It's just the possibility that he might do it, that he might use nuclear weapons. He might blow up a nuclear power plant. Who knows what this guy is capable of doing. So that's the problem. And as I said earlier, markets really do hate uncertainty. They would rather know a bad situation than worry about whether it's going to come or not. So that's what we're dealing with at the moment. But the good news is that there are some higher probability buys both now and many, many more coming soon. And the lower the market goes, the better those opportunities become. Now, human psychology is wired such that the lower the market goes, the majority of people become more and more fearful and less and less confident that the market is ever going to turn around and go back up again. But that is exactly the time that you want to get excited about buying opportunities. So yesterday I released a video about profiting from big corrections, which reflected the experience that I've had, particularly in recent years, and we've had several opportunities to do this, and it outlined the lessons that we can learn from 2018 and 2020, what it was I saw that took me on the path of the last couple of months. And if you haven't seen that, I think there'll probably be a link to that video on this one. But I've been warning that it was coming from last December, not because I've got a magic formula or I've got a crystal ball. It was just observe and respond. It was fairly obvious that the market was going through a change of character. And most people don't see it because they don't want to see it. Their mind is closed to it. They're enjoying the party and they don't want to know about it. And despite the fact that what I was starting to point to in December has just unfolded more and more strongly, I still get a bit of pushback from some people that reckon that I've overreacted on the whole thing and that it wasn't a big issue at all. Well, we'll see who's right at the end of the day. The signs are at the bottom, and this is the key point. The signs were pretty obvious to me just after we rolled over in late November. So a couple of weeks after that, the signs of a change of character in the market were pretty obvious. And the signs at the bottom, from my perspective, are going to be as equally as clear, because I just know what to look for. It's not rocket science, but you just need to have an open mind, and you need to be looking at a broad enough spread of charts and indicators to get an accurate picture of what's going on. So from the major lows, and this is reality, this is mathematical reality. When you get to a major low, the biggest percentage returns, that's when they occur. the downside risks are also far lower. If you're buying quality stocks and the stock has just fallen by 30%, then of course the downside risks are lower than they had been when the stock was at its peak. That's just basic mathematics. And the probability of success, if you've got a quality stock that will warrant a higher price in the future, then obviously the probability of success is far higher. Yet, when we get in these market corrections, our mind gets in a bit of a turmoil, and sometimes we just forget the bleedingly obvious, and that is the bleedingly obvious. So why wouldn't you give yourself the best shot at that opportunity of making some seriously good returns from the bottom of this correction whenever that occurs? As we were able to in 2018, and as we were able to coming out of the COVID crash, this is setting up in a very similar fashion. So the couple of questions to think about: what shape is your psychology in? How well have you played these periods before in the past? If you've been in the market for a while, just think back. We get these little episodes from time to time. Sometimes they turn into big episodes. How well have you played them? Have you stepped out of the way quickly as they unfolded? And if you then started buying back in fairly close to the lows, it's almost impossible to pick the lows unless you're just guessing. But if you are just observing and your mind is open, then you can generally buy fairly soon after the lows without giving away too much of the upside before you become convinced. So the what to buy is obviously the first question. And my highest conviction stocks, both in Australia and in America, were covered last week in the edition of Portfolio Analyst. And I think that members of that service, and there is a trial available, I think got a lot out of that. It certainly gave them a good foundation of what to look for. So it's identifying the stocks and the sectors that are going to do best coming out of this. And one of the realities is you want to go where there are unstoppable trends, because who knows what Russia's going to do, or China's going to do, or central banks are going to do with respect to interest rates. It's not within our control. But what is within our control is to go into areas that the growth in mega trends is virtually unstoppable. And so you've got this earnings tailwind behind you. And some of these are already on the move. Now, I don't believe we're at the bottom as far as the indices go. In fact, I'm almost certain of it. So I think there's further downside in the indices. But some stocks are already moving. They haven't fallen at all during this correction. And some are going to be starting to move very, very quickly, very soon. So, from here on in, there are opportunities. Looking at the American market, the S&P fell 1.3% for the week, which doesn't seem like very much, but the key ratio charts will tell it all, so I won't say any more than that at the moment. It's pretty starkly obvious what's going on when you look at all the various parts of the market. The US dollar surged up to 98.5. So this is a bit of a safe haven situation because of what's happening in the Ukraine. The 10-year yield actually fell to 1.73, despite the fact that we've got this upward pressure from interest rates having to rise to deal with inflation. There is a move into bond. People are buying bonds. I have no idea why, because it's the worst possible time to be buying bonds. But anyway, they are. And so that has caused some short-term downward pressure on the yield. Interestingly, a lower yield would normally be good for growth stocks and technology stocks. But because of the fear of many other things, and because of the dynamic of this multiple contraction that's playing out, that started in December, the growth stocks weren't actually bought on Friday night. The VIX spiked to 35. It remains elevated. It's been above 30 for the entire week. So that's a very high level. So that tells you how the market is thinking. So let's go in and look at some charts. Start with the S&P. The S&P is still above this key 4,300 point level of support. And so you might look at that chart and think, well, what's the problem? Because it hasn't broken down yet. But it's when you go beneath the hood, and let's do that, that you see quite a different picture. So a healthy market is one where growth stocks are leading the way and defensive stocks are very much secondary. And you can see with this line falling that consumer discretionary stocks are now underperforming the staple stocks very, very significantly. And Thursday and Friday were quite significant moves down. So this was mid-December when I started turning cautious on the market because of what I was seeing. And now we've just continued to form a series of lower highs and lower lows. And, and I can't tell you where the bottom might be. But obviously, we're looking for a turn up. This is the small cap growth stocks versus small cap value stocks. Now, it has eased up a little bit in terms of its downdraft. So on a relative basis, we're starting to see a bit more of an equilibrium between small cap growth and small cap value. But nevertheless, you have to say the trend is still down. And we're not seeing anything here in this last couple of weeks that would suggest that there's been a change there. This is the Russell 1000 growth, so really more mid to larger cap stocks versus the Russell 1000 value. And again, this is mid-December when I started turning cautious, and nothing has changed. And we've almost certainly got more downside because that's where it's pointing. And finally, the Nasdaq, which is more reflective of growth stocks compared to the S&P, which has got obviously all of the defensive stocks in there, and that's tending to hold the S&P up. So that's why the S&P is not looking as bad as the rest of the market is. And if you want to own defensive stocks, then that's fine. The problem is that long-term defensive stocks are not really where you want to be. You want to be where growth is, because growth overcomes problems. Growth overcomes pitfalls. So that's really where you want to be long term. So the Nasdaq, this ratio line is falling. So we've still got underperformance at that level. Now, if we look at the currency, there is the US dollar. So you can see we've had a real since Russia invaded Ukraine, we've had a real surge in the dollar. And we're starting to head back up towards these all-time highs, which was at the height of the COVID crash at about 103. So you can see just how much fluctuation there was during that period. We went from the low to mid 90s and up to 103, which is a huge move on the currency. But clearly now the US dollar is back in uptrend. But if we look at the Australian dollar, it's a really unexpected situation in a way, because normally we would expect that a surging US dollar would be putting downward pressure on the Australian dollar, and obviously it would be on a relative basis. But the Australian dollar has actually gone up because of commodity prices. Iron ore, coal, oil, and other commodities such as copper are all surging, and so that's been extremely good for the Australian dollar. So this is a situation we don't tend to see too often. So that's a summary of why I'm firmly of the belief that we've not seen the lows yet in this correction, and that it doesn't need to go that much further to constitute, to go beyond 20% at the index level, which constitutes a cyclical bear market. So there was our dollar, finished 73.15. And it's just all the commodity price surges, which we'll look at shortly. Now the ASX 200 ended up 1.6% up for the week, but that was because it got absolutely murdered the Friday before. and so there was a bit of a catch up. But you would think our index is going to be under pressure, and it was only resources that held it up. The Woodsides and the BHPs and the Rios that held the index up. Otherwise, we would have been down more significantly. So let's just take a quick look at the Australian market. So there's materials. So we're back almost to the all-time highs on materials. If we look at the ASX 200, you can see we're just below this key support level, but really I just don't find that the ASX 200 really tells me much at all. You've really got to look at the individual sectors. Healthcare is suffering from this multiple contraction, which is a global phenomenon. Finance is now coming off the boil, which is a very interesting one. In a rising interest rate environment should be good for banks, but because so much of the Australian market is represented by overseas funds, then they have different agendas, and they've obviously been selling our banks. But energy is where the big gains have been made, with West Texas crude now around about $113, $115 a barrel. That's been extremely positive for that sector. Now, turning to precious metals, gold was up by a whopping $82 to $19.71. We would expect gold to do well in a crisis and during an inflationary surge, and we've certainly had the inflationary surge for some time. But up until the last week, gold had really been not ignoring the crisis, but it hadn't really been responding to the crisis in Europe in the way that you would normally expect. But perhaps now, just in the last few days, gold is now starting to respond in that way. Importantly, it's right at key resistance, as we'll see on the chart, and it's really hard to feel confident about gold because we've been disappointed so many times in the last few years. Gold has had a little surge, risen to resistance, and then it's just slumped back again. So I'm not necessarily buying into this yet. But it is a new 18-month high, and it's a mere $90 off the all-time highs, as we'll see. What did the precious metal stocks do? Well, they certainly kicked up on Thursday and Friday, but I do note that there has been a significant underperformance by gold stocks compared to gold for something like 15 years. And I'll show you a chart on that if I can find it. So let's jump in and have a look at what's happening in this part of the market. Just on Bitcoin, by the way, Bitcoin as a safe haven investment is just not working at the moment. It's actually gone down during this crisis. So those that were proclaiming that Bitcoin would be a replacement for gold have perhaps got a little bit longer to wait on that. All right, this is gold on a daily basis. You can see really big surges occurred on Tuesday and then again on Friday. But if we pan back, and all those moving averages are now all aligned. 20-day, 50-day, 200-day, they're all turned up and the price is surging above it. So no question, gold has finally picked up some momentum. And if we look at the weekly chart, you can see we've now exceeded the peaks from May of 2021. And we're back to these peaks that we saw in January of 21 and of November of 2020. So we're probably just a touch above those peaks as well. So we're right at key resistance. So it'll be very interesting to see what happens to gold around this level, whether it can break out or whether it's going to slump back. And the all-time highs are here, not that far away at 2082. So only another $90 or so. Silver has improved, but again, silver is still really underperforming to a fair degree against gold. So that's a bit of a consideration as well. All right, let me just sorry. This was the chart I wanted. All right, this is a relative comparison chart between GLD, which is gold, the gold ETF, and GDX, which is the world's main gold ETF. And it's on a common basis, so starting from the same common point. This chart only allows me to go back to 2012, but I can say that it does. This correlation goes back another half a decade beyond that. So starting at the same point, the green line is gold and the blue line is gold stocks. So there is no question that gold stocks over the long term have been underperforming gold for a long period of time. Now that doesn't mean that that's going to continue. We might be getting close to a turning point. If gold were to break out above 2180 and set new highs, then that could really fire up the gold market. So I'm not saying to ignore the gold market, but at the moment just recognise that this is a 10 to 15 year underperformance and a significant underperformance by gold stocks. And yet gold stocks really should be amplifying the gains in gold. So if gold stocks decide to play catch up, and that's still an if, then that catch up could be quite spectacular. So a space worth watching, but really not one that I'm involved in other than what I've mentioned before, and that is I'm not buying gold stocks that require the price of gold to go up for them to perform. The only gold stocks that I'm touching at the moment are ones where the share price is almost certainly going to go up because of the development of their project, not because of higher gold prices. And I think that's just the prudent way to play it at the moment. Turning now to other commodities, because they were all on the surge as well. Copper moved rapidly higher to 482. Nickel's absolutely off the planet. It was only just a couple of weeks ago, it was about $10.50. Now it's at over $13. And the inventories, as we'll see, are at 5-year lows on nickel, so that's why. Now crude oil, West Texas Intermediate, absolutely exploded up to $115. I think it was only last week it was about 96. And the US is now talking about ceasing imports of Russian oil to really try and put the squeeze on them. And that will just further exacerbate what's happening in the oil space. There's the spot copper chart. We're now back to the same peak that we saw in April of 2021. So things moving along quite nicely with copper. And there's the inventories. That's the reason why inventories are quite low. We're now down at around 75,000 tonnes. It was only a handful of months ago that we were three times that level of inventory. So there's been a very significant move, and we're getting down to sort of critical levels. There's the spot nickel chart. You can see it's just absolutely rocketed away in the last week or two, and that's the 1-year chart. But to get a wider perspective, there's the 5-year chart. So you can't see it all that clearly, but it's sitting in the middle of this little square here. And if you go back to 2017, we were down around the under $5. Now we're at 13. So spot nickel absolutely surging. Nickel inventories, that's the reason why. This is the 5-year chart. You can see over the last year the nickel inventories have fallen off very, very sharply. So we've fallen from around 265,000 tonnes in the LME warehouse, and we're now down around about the 80,000 tonnes. So a huge drop off there as well. So certainly a commodity super cycle, and with electric vehicles and decarbonisation efforts around the world, it's just almost impossible to see the demand side changing at all. In fact, the demand side is probably going to just continue to surge. And we've now got restrictions because a lot of companies are now looking at either conflict areas of the world and wanting to stay away, or looking at areas of the world where there are ethical issues. And we've seen 3 of the world's major oil companies, basically at the cost of billions of dollars, are now withdrawing from Russia. So I think we're going to see supply struggle to keep up, and we're going to see demand continuing to surge. So the outlook for commodities really is very strong, and that of course suits Australia, just beautifully. So to wrap it up, there are already some good targets to buy, and members of the Insiders Club and portfolio analysts know what they are. But I'd highlight a couple of areas that are interesting at the moment. Defence stocks, obviously in the States. If you we don't have much to choose from here, but if you trade in the States, then defence stocks are looking pretty good. Battery material stocks have held up pretty well in Australia. They've been volatile, but they've really just gone sideways while this correction has been unfolding. Now, energy obviously has offered some really good gains, and we've seen a very substantial rise in Woodside. Not so much further down the line. That may still be coming, but everything I do in the market is around trying to get as much probability and certainty as I can. I don't like surprises, and I don't like uncertainties. And if there were to be a ceasefire in Ukraine, I'm not expecting there to be, but if there was, then the price of oil would just, dramatically fall. So that's an unknown for me. And so just if you're doing anything in the energy space, just be very careful, because, a single announcement could change that market quite dramatically. And when there's that level of unpredictability, I just prefer to ignore that sector, because there's plenty of other sectors where you can make money. You don't have to be in the energy sector. You make money somewhere else. So there's no question in my mind we're in a commodity super cycle. And for those of you that have been watching this video for any period of time, I've been talking about that since 2019, 2020. The fact that we would have a commodity super cycle that would extend into the mid-2020s and possibly even to 2030. Now, at that stage, the electric vehicle revolution was, it was growing legs, but it's just accelerated in a fashion that I don't think anyone could have possibly predicted. And so that commodity supercycle theme is even more so now. Now, in Portfolio Analyst last week, we did once a month, I do just basically a bit of a stock take, bit of an analysis of what the prior period has contained. I covered why I turned cautious in December, because the more you can learn from events that have happened in the past, then the better prepared you are for the future. So, you don't want to just ignore what happened in December and not try and learn from it, because you can incorporate that into the future. And I also talked about price targets on my highest conviction stocks in Australia. So it was a very productive session, is the feedback that I got. And there is a $1 trial, as there has been for quite a period of time now, for people to go in, have a look, evaluate the way that I do things, and if you like it, then stick around. There's a lot of value there. There is more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.